The next economic order is being forged not in boardrooms, but in mines and processing plants. Welcome to Commodity Supercycle 2.0, where resource flows dictate global power. Consider the Great Resource Shift. Traditional empires, built on oil and gas, now face new titans. Chile leading lithium, the DRC dominating cobalt, Australia securing critical rare earths. This isn't merely substitution, it's a fundamental realignment of economic influence. At the heart of this lies a decades-long supply crunch. Decades of underinvestment in mining infrastructure, coupled with environmental constraints, have created a structural bottleneck. Demand for metals like copper and nickel has surged, yet new projects take 10 to 15 years to develop. The result? Volatility that now defines the market. This volatility is amplified by the green transition. Every electric vehicle battery demands 5x the copper of a conventional car. Renewables require 10x more minerals per megawatt. The hunger for critical minerals is no longer a niche concern. It's the engine of the global economy. And this is where geopolitics reshapes everything. Fragmentation accelerates as nations pursue supply chain resilience. The EU's Critical Raw Materials Act, U.S. Inflation Reduction Act incentives, and China's vertical integration in battery production are not just policies. They're strategic moves to control the future. The winners? Nations with strategic minerals, robust infrastructure, and clear industrial policy. The losers? Those dependent on legacy exports without a transition plan. This isn't a cycle. It's a recalibration of global economic power. The new order is being mined, not made. The structural deficit in global infrastructure isn't merely a backlog. It's a decades-long erosion of physical and digital foundations. Decades of underinvestment have left supply chains brittle, energy grids vulnerable, and digital connectivity uneven. This isn't just about bridges and wires. It's the bedrock of economic resilience, now critically compromised. Simultaneously, the green transition has ignited an unprecedented surge in demand for copper and lithium, the new oil of the energy era. These materials are the literal wiring of decarbonization, yet global mining capacity has lagged catastrophically behind. The result? A supply crunch that's already straining EV production, grid modernization, and renewable deployment. Compounding this, geopolitical fragmentation has accelerated. Nations are prioritizing domestic supply chains and strategic autonomy over pure efficiency. This isn't merely protectionism. It's a fundamental recalibration of global trade patterns, driven by the twin imperatives of security and decarbonization. The perfect storm isn't coming. It's here. Underinvestment created the vulnerability, green demand amplified the pressure, and geopolitical shifts are now reshaping the response. This isn't a temporary disruption. It's a structural reordering of the global economy. Adaptation isn't optional. It's the only path forward. The 2000s were a singular driver, China's urbanization boom, fueled by steel, cement, and infrastructure. It was a predictable, cyclical surge, massive but ultimately narrow in scope. Today's 2026 reshuffle is fundamentally different. It's not one engine, but a convergence. The green transition accelerating global decarbonization, defense spending reshaping supply chains amid geopolitical realignment, and India's manufacturing surge unlocking a new growth pole. Crucially, the commodity basket has evolved. Energy metals, lithium, cobalt, nickel, are now central to the cycle, not ancillary. This isn't just about building cities. It's about building the infrastructure for a low-carbon, secure global economy. The implications are profound. This cycle won't peak and fade like the last. It's structural, multi-threaded, and inherently volatile. Policy shifts, technological breakthroughs, and geopolitical fractures will create prolonged turbulence. The 2000s offered a clear trajectory. Today's path is longer, more complex, and requires navigating a web of interdependent forces. Volatility is the new baseline, not a temporary anomaly. The new economic calculus is clear. Winners are those with strategic reserves, operational stability, and the technology to unlock them sustainably. Chile's vast copper reserves are no longer merely a commodity. They are the linchpin of the global energy transition, securing its position as the indispensable supplier for electrification. Australia, meanwhile, leverages its lithium endowment not just as a resource, but as a strategic asset, with its mining sector becoming a model for responsible, high-volume extraction meeting the scale of decarbonization demands. Simultaneously, the true disruptors are not merely the nations holding the reserves, but the innovators developing next-generation extraction technologies. Companies deploying AI-optimized mining, closed-loop water systems, and bioleaching techniques are turning environmental constraints into competitive advantage, reducing footprint while increasing yield. This isn't incremental improvement. It's a fundamental shift in resource economics, meeting stringent ESG mandates without compromising supply. Concurrently, emerging markets with robust export structures, driven by these very resources, are experiencing a powerful currency resilience. Vietnam's electronics exports, Brazil's soy and iron ore, and the Gulf's energy diversification are not just growing. They're strengthening their currencies through consistent trade surpluses. This export-led momentum creates a virtuous cycle. Stronger currencies attract deeper investment, fueling further productivity gains and technological adoption. The winners of 2026 won't just have the resources. They'll have the technology to extract them cleanly, the market access to sell them, and the financial strength to lead the next phase of global economic integration. The reshuffle is already underway. The 2026 economic reshuffle isn't merely about winners. It exposes structural vulnerabilities that will define the next decade. At its core, the losers are defined by two critical failures: resource deficiency and operational inflexibility. Consider energy import dependency. Nations lacking domestic reserves, particularly in Southeast Asia and parts of Eastern Europe, face existential risk as global energy markets fracture. Their reliance on volatile imports, coupled with insufficient strategic stockpiles, creates systemic fragility. When supply chains buckle under geopolitical pressure, these economies cannot absorb the shock. Simultaneously, legacy industries are failing to pivot. Manufacturing sectors anchored in outdated technology, like certain European steel and textile producers, face ruin as input costs surge and automation becomes non-negotiable. Their inability to adapt to the new cost structure, driven by carbon pricing and energy transition, leaves them stranded in a market demanding innovation. Finally, ESG scrutiny is no longer a compliance exercise but a survival metric. Supply chains lacking transparency, particularly in critical minerals and apparel, face de-risking by capital. Investors now penalize opacity. A single ethical lapse in a mining operation can trigger cascading financial consequences. These are not temporary setbacks. They are structural weaknesses that will deepen as the global economy reconfigures. The nations and industries that fail to address these vulnerabilities won't just lag. They will be excluded from the new economic architecture. Qanexra's analysis reveals the contours of this inevitable realignment. The 2026 economic landscape isn't about recovery, it's about recalibration. We stand at the inflection point where commodity scarcity is no longer a temporary shock, but the new baseline. Investors must move beyond simple diversification. A resilient portfolio demands a deliberate mix, strategic exposure to traditional energy for near-term stability, coupled with aggressive allocation to renewables and critical mineral supply chains. This isn't ESG compliance. It's risk mitigation in a world where energy access is geopolitical currency. Nations are responding with policy, but not through isolation. The imperative is securing domestic supply chains for semiconductors, batteries, and rare earths, not to build walls, but to build insurance against systemic disruption. This requires strategic partnerships, not just tariffs. And this reshuffle carries a structural cost. Persistent inflation driven not by demand surges, but by the physical constraints of a planet constrained by its own resources. Power is shifting from centralized hegemony to a multipolar system where energy security and supply chain sovereignty define national resilience. The decade ahead won't mirror the past. It will demand that investors, corporations, and policymakers accept that the old models of abundance are obsolete. The path forward isn't about chasing growth at any cost. It's about navigating volatility with a portfolio, policy, and perspective built for a world where every barrel, every chip, every kilowatt matters. This is the reality we must now operate within.